right, good evening, ladies and gentlemen. We are super pleased to have you this evening to check out this amazing opportunity here. We have Elan Memorial Park located in Houston, Texas. This is a core Class A mixed-use investment property, 297 multi-housing units, and we are pleased that you made the time to come and check it out. We're going to be sharing a whole bunch of information that I think or that I believe will be pleasing to your ears, especially if you are looking for a place to put your money that is not as crazy as the stock market. So welcome to this opportunity. All right, before we get started, we're going to, I hope everyone can see my screen, okay?
Yes, I can.
All right, I am on the legal disclaimer slide, and as all of you guys that have signed up for either credit card or a bank or any of those kind of opportunities, usually there's some kind of legal document that you gotta go through, and this one is no different. So I want to give you a couple minutes to go through this before we continue with the rest of our presentation. So a few seconds for you to take a look at this one. And just so you know, all this PowerPoint presentation will be available to you for you to review. Right off the bat, we want to give you an executive summary of this amazing opportunity. Kendu-Bay Properties and our partner ORP are very much pleased to present to you Elan Memorial Park apartment. Like I indicated, is a mixed-use core Class A property with 297 units with some 8 retail outlets. It was built in 2016. It's an amenity-rich asset located in Houston, Texas, a big metropolitan area here in the U.S. The sponsors have very strong experience in the Houston market. The lead sponsor currently own and manage about 1,000 units in the market. We have acquired and currently operate similar properties in the Texas market. So this place is a place that we're very familiar with, and we are a big player in that area. We have successfully gone full circle with our investors, achieving 3 times equity multiple with 50% plus IRR spanning over 32 months. Houston is a very strong market. Is also one of what we call tenant landlord-friendly areas, and so that means that dealing with tenants who are not unable to pay their rent, the legal framework, or the legal terrain allows the landlords to be able to take those pretty easily. Houston has 51 Fortune 1000 company headquartered there. So there's quite a diversity of not just employers, but as well as employees. And so that's what makes this a great market to invest, especially if multifamily is one of the areas that you would like to put your money in. And a great alternative to the stock market, as all of you guys are probably aware, especially with the recent turbulence in the stock market. This market offers excellent access to major employment hubs due to the region's low cost of doing business and highly skilled labor force. All those items that makes investing in commercial real estate, especially multifamily apartments, quite appetizing. All right, at Kendu-Bay Properties, we have philosophies, principles, as well as values that we go by. We do acquire assets that are located in landlord-friendly markets. So you probably won't find us in a place like California. You're likely to find us definitely in Texas, also Arizona, Georgia, Florida, any place where the terrain is a lot more friendly to landlord would definitely be interested in those areas. We acquire assets that are located in primary and secondary markets. Our focus is market with growth above national level. So we're talking about the job growth, population growth, income growth. And so Houston checks in all those areas. And so we are definitely excited about this, not just this property, but the area as well. We invest only in top submarkets of the targeted MSAs and also in low crime areas. Our guiding principle is we analyze investment with prudence, diligence, and care. Or act as fiduciary to investors, supreme focus on protection, preservation, and effective utilization of our investors' capital. We treat our investors, customer, resident, vendors, employees with utmost respect. We aggressively execute our business plan with the goal of doubling investors' money in the short amount of time. In fact, we have a list of recently 2 of our properties that have gone full circles. We are able to get invested to double their money within about 3 years. Our value proposals is to invest with our investors with 10 plus years experience, over 2,000 units, assets under management. We have strong expertise in Houston MSA area with over 1,000 units, assets under management. Institutional quality asset management, experience in owning and managing all assets, all classes of multifamily from C- to A+. We also big on value added function experience and quality of life. On the next screen is just talking about the assets that we own in the Houston area. We have Cambria Cove that we acquired in 2021. We also have Augusta, North Houston that we acquired in 2021 as well. And we also acquired Reserve at Eagle Landing in 2021, besides Live Oak and Grove at Seabrook. So as you can see, we are very well established in the Texas and especially around the Houston area because like I indicated, Houston checks off on all the items that we look from: diversity of employment, diversity of employers, population growth. All those things makes it quite an appealing market for multifamily investing. What else I need? So one of the key questions that is probably going through your mind is, if you're new to this, the big question is why multifamily? Multifamily is big if you're looking for safety, stability. As we all know, and no matter what happens, whether the economy is bad or good, everybody gotta have a roof over their head. And so when the economy is bad, that some people might be running away from single family homes, guess where they're gonna be heading? They're gonna be heading to apartment. And so it makes it quite an appealing investment space due to safety and stability. The other thing that also makes multifamily great is consistent passive income. If you're a passive investor in this kind of deal, you park your money here, you'll get quarterly distribution that will be coming to you, and you never hear that apartment unless of some other calamity, or then most apartments usually are doing pretty well, ensuring that investors get the passive income consistently. The other benefit that you'll be able to get by investing in multifamily is tax benefit. And at this point, I also want to encourage you that anytime you invest in this kind of investment opportunity, is always advisable that you talk to your accountant as well as your tax advisor. But there's great amount of tax benefit that comes from investing in multifamily. Also, is also an opportunity to diversify your income sources. If you are a W-2 employee and you have some money, maybe from a previous 401k, you can do self-directed IRA that now allows you to be able to invest in this kind of investment option. Leverage time and money, as well as hedge against inflation. The next one is to introduce you to our lead sponsors, Mr. Jack Aduo, and you'll be able to, you can click on his bio there. He's the founder of Kendu-Bay Properties. Is the lead sponsor on this property. Is assisted by Mr. Raj Sarangam of ORP Investments, and both of them are super glad to bring you guys this opportunity that as we go through the rest of this webinar, you'll be pleased with what it has to offer. And then you'll get an opportunity to ask additional questions at the end. Hopefully we'll address it fully so that you be able to participate in this amazing opportunity. And with that, I want to switch it over to Jack so that he can discuss the rest of the property. While I'm waiting for Jack to get on board, let me just go ahead and mention this other information on this slide. Oh, there it is.
All right. Hopefully you guys can see my screen. Tom, can you see?
Yes.
Okay, wonderful. All right, guys. Sorry about that technical problem. My apologies. So yeah, as Tom indicated, we have strong presence in the Houston market. We have a lot to love about the Houston market just because of the market fundamental itself. With us having over 1,000 units in the Houston market is a clear indication of how much we're in love with that market. So as we go through the rest of this presentation, the approach we're going to take, we're going to talk about the Houston MSA, and then we're going to go down to the sub-market itself, and then into the property. So basically, kind of we drill down to the nitty-gritty of the asset itself and the opportunity itself. So, anybody who want to do investment, one of the key things you always want to do is understand the market itself, because it's the market that's going to, make it or break it for you. You have to make sure that you're investing in the right market, not just in the right property. You can have the best property you want, but if it is not in a good market, then it's basically kind of like throwing money down the drain. And so here's the reason why we believe this is a good market. So you guys all know, most likely, I'm assuming everybody knows, this is the 5th largest metro in the country, the energy capital energy capital in the world. Is a 51 out of the Fortune 1000 companies are headquartered in Houston, and is the largest medical complex in the world, the Houston Texas Medical Center, that is. With over 1,300 acres, it's definitely the largest and definitely a major economic hub in the Houston MSA. The market itself, Houston is been ranked number 4 in terms of economic growth potential and startup ecosystem, which means when you compare among the largest metro, Houston is very, very friendly towards starting new businesses. It's a city of the future. The relocation destination for young adults has been on top. The Houston market itself, the median age is 35 years old. The white collar job is about 63%, and that's very key because that's where the big money is. The big money is in the white collar job. So the fact that 63% and white collar job is a really good thing for the MSA. In 2020, 52,000 people moved to the Houston market. And right now, the population is about 7.1 million. It is projected that within the next 5 years, it's going to increase to 8.3 million. That's about 16% rounded up increase in population. There's 800,000 people in the Houston market that are making over $100,000 per year. There's over 900,000 apartment units in the Houston metro. And the median household income in the Houston metro is $70,000 compared to the national of being the mid-50s. So it's a very, very strong market with very strong market fundamentals. Now let's just look deep further, because I think one of the misunderstanding about Houston is that some people think that it's only all about energy. And we want to make sure we dispel that, because it's very critical to see how the market itself is very diversified. Yes, there's a strong energy presence in the Houston market, and that's a great, great thing. But beyond energy, there's even other things that are really big in the Houston market. Healthcare, as an example, right? There's more than 100,000 jobs just in the Texas Medical Center itself, just that one area only, not all the healthcare in Houston, just that one only. The Texas Medical Center, which is the largest medical complex in the world, has $25 billion in GDP Right now, there's $3 billion under construction in the Texas Medical Center. So that's healthcare, which means, there's a lot of high paying job in the Houston. And by the way, Texas Medical Center is only about 4 miles away from this property. The Port of Houston is the largest export port in the entire country, the largest. You always hear about, the Long Beach, New York, and all those other areas. But when it comes to the numbers themselves, like the actual tonnage, Port of Houston is by far the largest in terms of export. We have 2 major airports in the Houston area. There's over 130,000 logistic industries workforce, basically, jobs in the port itself. Over 4,600 warehouse and establishment in the Port of Houston area. When it comes to energy, the Houston, there's 4,600 energy-related companies in the Houston area. That's over 110,000 jobs. $3.7 billion, basically about $4 billion currently are clean energy ventures going on in the Houston area. When it comes to technology, there's over 8,000 technology companies in the Houston area. $28 billion in economic impact. Over 500 digital tech companies in the Houston area, and almost 250,000 jobs related tech in the Houston area. So you have very high, very well paying, very reliable jobs and industry in the Houston area. Like we indicated before, there's a reason why 51 of the Fortune 1000 companies in the world call Houston their home. A lot of companies are partially relocated or completely relocated to Houston. My background before I fully joined real estate, I was in the IT space. I graduated out of college with computer science, with minor in math. I used to work for HP. That's where I got most of my IT career. And HP just relocated to Houston. The division where I used to work, they just relocated to Houston. As a matter of fact, they relocated to about 4 miles from one of our properties. So there's a lot of great, reliable employers moving to town. Okay. So more about the Houston market. I just want to make sure we respect time because we're 30 minutes into it. Aerospace, the NASA, as you know, is there. The annual and economic impact is about $8 billion. ConocoPhillips is headquartered in Houston. Advanced manufacturing. This is very important. Over 6,000 advanced manufacturing companies are based in Houston. It's the number 2 in the nation. $83 billion in advanced manufacturing industry. Biotech and life sciences are all there. Over 5,700 medical researchers in the Houston MSA. So once again, as you can see, there's a reason why we choose market like Houston, just because of the market fundamental. And as Tom indicated earlier on, part of our philosophy and principle and goals is to be able to invest in markets whereby the job growth, the income growth, and the population growth is above national. And as you can tell, with this kind of employers, there's a lot to love about the Houston market. So here's more recap about the Houston market. I'm not going to go through this in every details. We'll be sharing all this with you guys, after the webinar, so you can be able to see. The sub-market. So now we talk about the Houston. So we focus, as Tom indicated, the first thing is we invest only on landlord-friendly state. So we chose Texas. And then when we chose Texas, we just don't do all over Texas. It has to be a primary market or a secondary market in Texas. In that case, Houston. Now we chose Houston. Now we are even more targeted to a sub-market. We just don't invest anywhere in Houston. We invest in areas, as Tom indicated, that has low crime rate and top sub-market in the Houston, like the sub-market where this property is. So let's look at the sub-market. Now we've drilled down to the sub-market where the property is, because this is where majority of our tenants are. This is one of the most desirable addresses in the Houston market area. The walkability in this area is phenomenal, over 70%. There's very high-end new apartment coming left and right in this market because there's just a lot of population growth going on in this area. And of course, lack of cost-effective opportunities to build because prices for home in this area is very, very high, make it extremely attractive. The average home price for single family in this submarket is $1.9 million, basically $2 million. Think about it. Most Texas is like $300,000. So when you talk about 1.9, you know that there's a lot of demand in this area. This submarket is the #1 submarket for this type of asset, this class, the core class A asset. Is the overall #3 in the entire metro and the top 3 with regard to rental rates and absorption. And that's very key because you always want to know, it's an indication in terms of the migration to that area. You always want to see that there's more apartment coming in, but more importantly, people, they're all being rented. And that's, you measure that with the absorption rate. As you can see on the bottom of this slide, bottom left on this slide, the T12 is 1,200 that were delivered. And the absorption is 2,900. So in other words, they need more than what was delivered. And that's very, very key. The average occupancy in the submarket is in the mid-90s. Our property as of today is about 94%. So we're right there on the money. And there's just, room to grow in rent, and we'll show you that later. More about the submarket from a retail point of view, as indicated earlier on, this property is a mixed-use luxury apartment. There's 297 apartment units, and there's 8 retail spots. The ground level, the downstairs are all retail spots. So when you look at retail for this submarket, this is one of the affluent neighborhood with luxury multifamilies. And that has elevated the buying power. And because of higher buying power, you have luxury retail retail operators coming to this submarket. You basically, any kind of luxurious retail operator is in this submarket. When you look at it in terms of the delivery, look at towards the bottom left there. As you can see here, in the trailing 12, 90,000 square feet was delivered, but the market needed 193,000. It's now less than half of what's needed was delivered, which goes to show how much there's a demand for retail in this market. And I will show you how our property is doing in terms of how our retail is doing, and you'll be surprised. Now let's drill down to the location. So we've talked about the submarket. Now we're going down further to the 1 mile and 3 mile radius, right? So now you understand exactly the cross street, a couple blocks away from the property, what we have going on there. So when you look at it from a 3 mile radius of this property, there's 168,000 jobs within 3 mile radius of the property. The same 3 mile radius of the property, there's 180,000 jobs. I mean, 180,000, sorry, my apology. There's 168,000 population, but there's 180,000 jobs. So in other words, there's more jobs than the people that live there. And keep one thing in mind, not everybody works. So that 168,000, only a small portion of it works. And the one that works, if you do the numbers, it boils down to about 3 jobs for every 1 working adult in the 3 mile radius of this property. The average household income is $166,000. And like I indicated, the average price of a home in that area is $2 million. And the same 3 mile radius, there's 50,000 employers or businesses within, no, 18,000, my apology, within the 3-mile radius. So you basically have a strong supplier workforce and employment opportunity. Tenants don't have to drive miles, like 10 miles, to look for a good job, because everything they need is within 4-mile radius. Now, let me just plug in my power real quick here, real quick. Okay. Now, more about the location. Within the 4-mile radius of this property is the downtown Houston. Downtown Houston about 4 miles, and that's 51 million square feet of office within the downtown Houston, about 170,000 jobs. The Texas Medical Center is about 7 miles away from this property with over 100,000 jobs. The Elan Memorial Center is about 4 miles away with over 100,000 jobs also. And with the Elan, it's both upline and downline. And the Galleria is 4 miles away. The Greenway Plaza 4 miles away. The West Chase District is about 10 miles away. So everything you need is within 10 miles less, with majority of them being 4 miles or less, from the property. So here's some of the retails in that same general area. As you can see, brand name, everything you need is within that general area. Tenants don't have to go too far from the property to get what they need. Recreation and entertainment, just a little bit. Memorial Park, which is the namesake of this property. This property is on the one of the main entrances to the Memorial Park. The Memorial Park is the largest urban park in the United States, in the entire country. It is twice the size of Central Park in New York. It's about 1,500 acres of land, over 1 billion in estimated value. There's 4 million visitors that go to that property, to Memorial Park every year. And remember one thing, like I indicated, we're on one of the main entrances towards there. So which means a good chunk of those people that are going to the property, that are going to the Memorial Park, actually driving by our property every single day. We have over 30,000 cars that drive by the property, by our property every day. 600-acre nature park, everything you need, the park offers. So is a major attraction, and that's part of what makes the location very, very attractive, because of the park. Here's more highlights about the property itself in terms of the attributes of the property, the unit size, the address, the square foot. We will be sharing this with you on the webinars, after the webinar. So we're not going to go through this in detail, but if you ever need to see the specific about the property, like how many garages we have and how many parking spaces we have, all those are broken down here for you to see. Here's an overview of our retail. As indicated, we have 8 retail spots. All of them have now been leased. The last one is now under contract. We're negotiating contract for the last retail spot that was still open. So pretty soon, within next couple months, within next month, we should be fully 100% leased. As you can see here on the rent, our rent for our retail spots are well below what our comps are getting. The average lease left on the retail spots about 5 years. So most of them still have ways to go before they come up for renewal. Here are some pictures of the properties. And I just want to do status check. Tom, can you still hear me? I just want to make sure I'm not missing anything.
Yes,
okay,
I can hear you.
Okay. All right. So here's more pictures of the property. Okay. And about now that we've talked about the location, now we're going to talk about the property itself, right? So we're drilling down deeper and deeper into the property. As indicated, it's centrally located next to Memorial Park, which is very important. It is definitely one of the most amenity-rich assets in the location. I mean, the property comes just with everything a tenant needs. But again, that's because there's a certain type of demographic we're targeting. Remember, the average household income in that area is under 60,000. So these are tenants that have certain set of expectation, and we need to meet those expectations. One of them is amenity that we provide at the property. We have everything from a dog wash to a lockbox to concierge package to pool, barbecue. Everything they need is on the property. The average the walk score is 73% compared to the entire Houston metro 40%. So most tenants in this property do not have to drive. And what makes this property attractive is that it just does not offer the amenity, but you also have the retail part. Like, for example, if you're working from home, you can eat downstairs, or go to the gym, get out of the gym, go eat downstairs or go grab a coffee, and then go to the rooftop and just enjoy, catching up on an evening, football, game that's going on. Everything is in there. You don't have to stay in your room. You can be in the same property, get everything you need, from free Wi-Fi, to everything you need without going anywhere. So very, very attractive to them. That's part of the reason why we have maintained high occupancy, and there's been a great amount of tenant retention. As a matter of fact, the average tenant retention every month has been well above 60%. The month of last month, February, that is, the average renewal rate for tenant was 67%, almost 70% of tenant decide to renew. The month of March, this month, that is, 67% already renewed this month of March. So they love the area. They want to stay there. And the property has everything they need. If you look at the average household income in that within that 1 mile radius of 166,000, and you compare to average rent at the property of about 1,800, which means the tenants are making about 7 times the average rent for this property. So this property is very affordable compared to what the local demographics are earning. Okay, a little bit more about the property itself. As indicated, I don't want to repeat myself, so some of this might look like repeating, but we just want to make sure we drive the point home, in terms of location, being near employment hub, modern interior, upscale granite countertops, stainless steel appliances everywhere, USB port, smart package, everything you need, the property is offering. So if you want to invest on this deal, right now we're only offering Class B. We used to have Class A. We're not offering Class A anymore. That one is sold out. So there's only Class B available. The average return we're projecting is about 9%, average over 5-year holding period. We're projecting 2x equity multiple and 100% ROI. So this is an example. If you had to invest $100,000, you basically get $46,000 from, during the holding period, $56,000 at the time of sale, which comes to $102,000. So you basically get your initial $100,000 plus another $102,000 on top of that, which kind of make it like $202,000. These are the projections, and I think it's very important to understand that these are the projections. And because this is like a big ship, you can turn it overnight. Those returns tend to be very low year one. As you can tell, year one, we're only projecting about 1%. So please set the expectation right. But you can look at it in terms of the total return on the project. What we're basically saying is 5 years or less, you're going to double your money. We are planning on refinancing after 1 year. We negotiate with lender to refinance after 1 year, which means basically come this September, we're going to be looking into refinancing and pulling some money out. So we are very confident about the projection. We have the experience, based on the property we run in the market. As a matter of fact, we have a property, just one of our properties about 3, 4 miles, 5 miles from this property. We just refinanced last year. And that property investors pull a good chunk of their money out. I would have to check 60%, give or take, somewhere in that range. And we acquired it in October 2021. And by next year, before October, we had refinanced and pull a good chunk of money out. So key part of business is being able to basically, pull a good chunk of the money out as part of refinance, hold it for another year, and then turn around and sell it. Scorecard. This is a very important slide. And here I tell you why. I didn't clarify on this earlier when we started the webinar. This, when you're subscribing into this deal, this is a property we already acquired. We acquired it last year, September. We currently own this property. So if you were to subscribe to it, you're basically going to own it from day one. You don't have to wait for us to close. You're going to basically be part of the ownership from day one. That's one thing. Second thing, so with you, so one of the things we want to share with that is, therefore, we want you to see how we've done since we own this property. So we acquired in September, and if you're to measure our performance since we acquired the property versus now, that's what this slide is showing. So when we got this property under contract last year, when the seller owned it, when we got under contract, the rent income was $5.5 million. Well, since we acquired it, if you look at T3, trailing 3, and then you annualize it, because we haven't owned it for, we have not owned it for a year yet. So we're taking a look at T3, which is a common industry normal measuring things. By the T3, I'm referring the month of February, the month of January, and the month of December. If you look at those 3 months and annualize it, we are basically projecting year one, we're going to make about $6.2 million. In other words, we will increase rent by 12%. And if you compare that to our projection, what we had assumed on our underwriting, when we were trying to acquire this property last year, as of September last year, we assumed that it will take up to this year, September, for us to make 5.9. So in other words, it's March already, or it's February, end of February, that is, and we got $6.1 million, and yet we were saying that we're going to get 5.9 by this September. So we are way, way ahead of our projection in terms of what we had assumed on our original assumption versus what we are able to achieve as of today. Rental income, rental income from the retail, the tenants themselves, right? The retail tenant, the 8 spots we said. When we got this under contract, the seller was getting 468. Well, we've increased that by more than $100,000 to 582, annualized, that is. In year one, we had only assumed that we're going to get 493. So we are well above what we'd have gotten, what we had assumed that we were going to get by this year, September. Other income, the same story. We are way ahead of game. Other income, we haven't achieved our goal yet for year one, which is September, but we're well on track to achieving that. As you can tell, we're gone by over $60,000 annualized in other income. So when you subscribe into this deal, I'm just going to go back to this previous slide. So when I say this projection here, as you can tell, I believe we can be able to achieve this projection and this returns we're telling you, because this is hard number, this is something you can verify. This is not a projection. Like when I say 6.182, this based on actual data, and it's based on us running the property, not how we think we will run the property. All right, so investment summary, just a little bit of let me try to move this thing here. There you go. So investment summary, the purchase price for this asset was $83.5 million. Equity amount is about $25 million. Entry cap rate, we assume was 4%. Not assume, the entry cap rate is 4%. We're assuming exit cap rate is going to be 5%. cash out refinance in 2 to 3 years. That's our assumption. But like I indicated, we're going to start pursuing refinance as early as this September. So basically a year into it. For Class B, 3 to 5 years holding period, the profit split is 70-30, whereby, once the preferred investor paid, the balance is split 70-30, whereby you get 70%, we, the sponsors, get 30%. Average annualized return is 20%, on that, 2x equity multiple, 16% IRR. And one thing important, excuse me, once we more than double your money, then we're going to reduce this profit split to 50-50. So it's going to be 70-30, whereby you are getting 70% of the profit. And once you more than double your money, so in other words, if you put $100,000, and then once you get $215,000, then it becomes a 50-50 split. So us as a sponsor, our goal is to make sure we go above and beyond that, because the real juice for us is after you double your money, then that's when you get that extra piece of the pie. Okay, business plan. So this is where we explain what we are going to do, to achieve those projections and tell you what we're going to do for the next 5 years. This is probably the most important slide in the entire presentation, because it tells you what we plan on doing to make those returns a reality. The first thing we're going to do is revenue generation. And by that, we're going to increase rent. And as indicated on that scorecard before, we are increasing it already. We are increased rent income by over 12% since we took over. Ban of loss to lease, remove discount that were given to staff. The seller had some staff that were getting a number of discount. We've already removed those. We've started charging on other income, or even other income that already charging X, we're going to increase it by a little. Sometimes all you have to do is just increase it by $5 to $10. You don't have to increase it by a lot. And that $5 to $10 times 297 times 12 months, divide by, say, 5%, exit cap rate, the values goes through the roof. You'll be surprised. You'll be surprised what $10 can do on a 297 unit deal. Our plan is to aggressively promote optional income, such as smart package. We're already working with the property management of that. Storage units. Basically, all in all, we're projecting about 8% rent increase. But I want to be clear on this. We're already getting 8% rent increase every month on renewal. Our renewal rate, since we took over, there's no single month that on renewals has been less than 6%. It's been 6% and above. As of last month, it was 7%, give or take, somewhere in that range. No, it was 8%, give or take, somewhere in that range. On renewals, that is. New lease is higher than that, but new lease depend on what the new lease is going to be. It's more than 10% of new leases. Interior and exterior improvement. Our approach is our value-add approach is valued as a function of experience and quality of life. This is an affluent demographic. This is a Class A asset, about 6 years old. It's still a brand new asset in a premium location. So it's not like, gonna rip up the wall to the stars and, do this and that the way you do on a C-class. That's not gonna happen here. So it's a different type of value add we bring in here. In this case, is improving their life, quality of life, and enhancing the experience. Remember, they can afford it. And we want to make them happy so that they can pay more. And that means, doing certain things. For example, adding EV charging station. This is an affluent demographic. You'd be surprised that they don't have EV charging station. That's one of the key things we gotta add right away. Refresh the grilling station. We're gonna repaint the entire exterior. Even though the property is only 6 years old, it's very important to note that our competitors are like 1 or 2 years old. So we have to get that new refresh look. So we're already working on that. As a matter of fact, we already have a number of beds. We're looking and we plan on starting painting within next 1 month or so. So we're going to do certain things that improve the experience and quality of life of the tenants and the property, things like energy efficient light, smart package, technology package, media package, premium household items that we know that is very appealing to them. And in my opinion, if you can do that and just charge $20 extra, they'll be happy to pay for that. And that's all we need to make the numbers work for us. Another thing we're going to do as part of business plan is operational improvement and the expense reduction. On this asset, we are working with the Greystar, which is the largest property management company in the entire country. They have some of the best industry standard and best in class approach to property operations. We've reduced payroll already by over 20%. Our target is 30%. And that's by reducing staff and also not being open every single day. The seller, when they own it, they had the property being open 7 days a week, 9 to 5. With us, we simply remove Sunday, and on Saturday did half a day, and that's all we need to do. We don't need to make much changes. Remember, this is a stabilized asset. It's like 94%. You don't need to be open on Sunday when you're fully occupied. Reduce property management fee. That's about $80,000 savings. Between that 3% to 2%, that 1% itself is about $80,000 savings in that. Now you tell me 80,000 divided by 5%, you can imagine what kind of value that comes to. Reduce contract expenses, renegotiating some of the contract with some of the key vendors, implement more tenant engagement activities, integrate in Juniper Square and Entrada as part of running as some of the best software to help us run the asset. Of course, protesting tax is key part of our strategy to reduce expenses. All in all, we can reduce expenses at least 15% in order for us to meet our goals. Exit strategy is very simple. Option 1, refinance, hold it for 1 year, and then sell. Option 2, sell after 1 year or two to 3 years, so as soon as it becomes available. Or option 3, hold it longer until we meet the 2x equity multiple and then sell. It's very simple. This is the approach we've always taken. Our goal is 2 to 3 years, but we want you to assume it's going to be a 5-year hold. So at least we want to set that expectation. Rent comps. So here's where you analyze, we compare rents, and I won't go through this in details, but we'll be sharing with you. I just want to drill down to one area in the rent because I prefer to look at the actual data rather than graph, and I just want to point a few areas in rent comps. Take a look at this 2-bedroom here. You see this 2-bedroom here? Now, this 2-bedroom, take a look at this property, the Westcott here, the first one on this list here, 1,500 square foot, 2-bedroom house. They're getting $5,000. We're getting, as of our performance, $3,700. The seller was $3,400. Think about it. That's over $2,000 difference, right? About almost $2,000 difference between what the seller is getting versus what they are. That property is literally across the street from us. It's not like we're talking about property across the other side of town, or a property like 2 miles away, or on a better side of the town or the street. Or it's literally across the street from us. And that property, the only difference is 5 years newer than us. That's the only difference. So in other words, the same vintage as we are, same class A, of a similar premium amenities like the one we do, but they're getting 2,000. And in my opinion, if we can get 3,700, we don't have to get 5,000. We don't have to get 4,000. That just 3,700. That's what we're asking for. And if you can get that, then you will double your money. Of course, our goal is to get as much high as possible, but it goes to show you how much we are below on the rent. So a lot of all these assets are like within 2 mile radius from us. They're not, none of these are far from us. So when we're talking about this property, those 2 mile radius, all of them similar vintage to us. So we're not comparing like, 70s versus a, 2020 asset. And they're truly our competitors. And as you can tell, they're getting good rent, and we believe we can achieve similar rent. And as you can tell on the scorecard we showed you earlier on, we were doing that. We were achieving those rent. It's not like a dream, it's a reality right now. Sales comp is another way to look at it. Average, price per square foot versus average price per unit. When you want to think about what we sold the property for and what we bought the property for. This is 305,000. With us, we bought ours here at 267. That's about 40,000 rounded up, 40,000 or 38,000 to be precise. Price per unit difference between what the market is getting versus what we bought this property. Now, if you look even more on the sales comp, and this important from buying point of view, but also important from selling point of view, we have property here, that, look at this one here. It's about 2 miles from us, right? The distance about 2 miles from us. We're not talking about property that's far away from us, 2 miles from us. It's sold for $560,000. It's only about 5 years older than us. So there's a big gap between what some of the property have sold for in that market versus what we believe we can achieve. A good number of properties have sold, for well above what we got our property for. And I believe when it comes time to selling, our assumption in terms of price is easily achievable because we think about selling 5 years from now, and these properties are already getting the price per unit that we think we're going to get 5 years from now. Here's some of the unit mix. So you can see is the square number of unit types of the property. Here's our 5-year projection. And this is very important slide. And one important thing to also note is one thing. This is a snapshot of a time when we're acquiring this property. We intentionally did not change the numbers here because these are the numbers when we're acquiring the property we're underwriting. Of course, things have changed, and these are some of the things that have changed. For example, if you remember the scorecard I told you, right? The scorecard I told you, I say that year 1, which is September of this year, will be getting 493 on retail income. And right now is already 500,000, if you remember. Year 1, we said we're going to get 742 here on retail, on other income. We're getting 680, was it 680 something thousand already on this one here. Here also, when it comes to rent, we'd assume that September, but year 1, because we acquired the property in September, we assume that in September of this year, we'll be getting 5.9. Well, we're already getting above $6 million already. So have we met year 1 projection? Of course, we're well above year 1 projection. And that's very key, which goes to show how conservative we are in our underwriting. Because when we underwriting, we want to make sure we give ourselves wiggle room and not be able to, be ahead of ourselves. So we give ourselves a lot of room to make sure that we're able to achieve our projections. The break even for this property is 60%. So in other words, you'd have to go all the way down to 60% to get to break even. And one thing to keep in mind with that regard is that I don't foresee this property getting to 60%. If you get 60%, it's because there's something happening like fire or natural disaster, hurricane, whatever it is, right? But here's the good news. If that happened, insurance is going to pay us for the entire time while they're empty. That has happened to some of my property, like I had a property in Arizona where one of the building caught fire or tenant put fire on it. Well, then insurance paid us the entire time while the building was being renovated. So, I'm not concerned about building catching fire or anything. We're already paying ridiculous amount on insurance, and it's part of the doing business. And so if anything happens, I pray nothing happens, but if it happens, it's good to have that peace of mind that insurance is not only gonna repair the entire building to a new condition, but also pay us for the loss of business while we are repairing that building. All right, so I think, Tom, I'll let you take over from here. I'll stop share and you can reshare.
All right.
Just 1 second here. Yeah, go ahead.
All right, can you guys see my screen now?
Yes.
All right, thank you very much, Jack, for all those amazing information on this property located in a great metropolitan area. This slide is talking about the fees that are involved with this investment opportunity. There's a 2% property management fee. There's 2% asset management fee, 1% acquisition fee, and lastly, a 0.5 capital event fee. And obviously, if you have any questions on this, there's going to be an opportunity at the end of this webinar for us to clarify further what all those fees is all about. And let me go to the next screen. All right, so why invest in this deal? Return on your investment. We are planning to hold these properties for up to 5 years. So long as we're able to double your money within the shortest amount of time, then one of the options is to sell it so that you get your money back and hopefully be able to invest in some other opportunities. At least is the Class B. Class B shares are the only ones available, like Jack indicated. And so the plan is for us to be able to work so hard and make your money double within that whole period. This is a Class A plus property, great location near great employment. Rent is below 100. And one of the slide that Jack shared with you guys was showing you guys what the property is currently doing. We talked about the projection on one screen, but because we've owned this property since last year, we have some hardcore numbers that we can share with you guys, and I hope you guys were able to catch those. And we look forward to any questions that you guys might have to help drive that point home. We had gone through a conservative underwriting. This is a COVID-19 tested property. One of the things that I like to highlight when it gets to this point is what Jack mentioned about the 60% figure. And that basically means that the property would have to have a vacancy of about 40%, or occupancy of only 60%. Keep in mind that at this moment, we are about 95% occupancy. And so we would have to reduce significantly for us to be able to get to the break-even point. The area is very affluent, 166,000 median household income. And Jack mentioned about, salary is about 7 times what the rent are going for. So the demographics have a lot of flexibility with regards to how much they can afford with regards to rent. There's also opportunity for tax write-off due to cost segregation study that is already underway and that we will be sharing with you guys. And so what that basically means is when the cost segregation study is done, you're going to be able to get a K1 that is negative that you could text to your tax preparer to help you deal with it. But I also want to emphasize that I am definitely not a tax advisor, and you want to consult with your tax professional on how the cost segregation will apply in your case. But having invested in a number of properties already myself, I know it's a big advantage to have. It's what makes multifamily investing quite an appealing investment vehicle. You have experienced sponsorship team. At least 2 properties have gone full circles where investors have more than doubled their money. And so rest assured that you are getting a team that already had their hands in the business. And so this one is just another opportunity that we will bring it to the investors to participate in. So the next steps on this investment process is a link to subscription we provided after the webinar. You can review the documents via the link provided, discuss any question that you have, and then once your subscription has been approved, then you'll be given instruction to wire your funds. When the funds are received, that's when you really are in the deal. It's first come, first served kind of opportunity. So we want to encourage you to subscribe the soonest and also wire your funds as soon as possible. And we want to encourage you guys to do that. The contact is right here. There's a website, there's a phone number, and there's an email address as well. And I think this is pretty much the end of the slides. And so if you do have any question, I'm going to stop sharing here. If you do have any questions at this moment, you could type it, and then me and Jack will address your questions. And if you do come up with other questions after this webinar, of course, you can always reach us through email, investors@kendu-bayproperties.com, and we'll be able to address it, address your questions at those times as well. So I'm going to stop sharing.
All right. Thanks, Tom.
No problem.
Yeah, so feel free, guys, to post any question you have on the webinar, so we can be glad to answer any question you might have. You can ask anything and everything about this deal, or just general investment in general, the market, anything real estate related. We'll be glad to answer any question you might have. Okay. I guess we must have done a good job, Tom.
All right.
Nobody has a question, so that's a good thing.
I see one question. What is the list investment amount?
Yeah, go ahead.
The minimum to invest is 50,000 to invest in this deal. Obviously, the higher the amount invested, the higher the priority that you'll have.
Right.
All right. Sanjeev, do you want to type your question, or do you want to? Okay, there we go. So Sanjeev is asking, this property was acquired last year, and I believe you already went through round of investment. Why is the second round of investment? I'm referring to why second
Yes.
round of subscription.
So basically, when we acquired the property, initially we had it at 506B, which means we could only market to a limited set of people within our group, only people that we know. And a number of things have happened. One, the lender changed, they reduced the loan amount right before we acquired the property. We had to pay more in terms of rate cap purchase. And so by the time we closed the property, we didn't have all the funds. We had to scramble basically to get the deal to finish line. And right now we're simply trying to bridge the gap. One, we need more money for rainy day. Two, we have some earnest money that we've not refunded yet. We need to refund those earnest money because we were planning on doing those at the time of closing, but we didn't have all the funds. Three, things like we need to put more money for rate cap. Right now is 18 months. Even though our goal is to refinance in 1 year, we still gotta be cautious and try to be safe. And so basically, it's not a second round of uh, racing. Is more or less we never stop. We just decided like, hey, let's open this the rest of the world. So we change the offering from 506B to 506C, so we can be able to raise all the money we needed to begin with. So we've never just gotten all the money we needed for the entire project. And as you can tell, it's quite an expensive project. I mean, it's a $3 million purchase, so it's not a small, purchase, And on this, we just need slightly over about $1 million or so that we need to bridge the gap. We're not trying to raise a lot of money in this case.
All right. The next question, can you talk about current lender and the financing structure?
The current lender is a bridge investment. Is a warehouse lender, which means it's kind of like almost like their own in-house money. They don't trade the money in Wall Street, like like give us loan and then turn around and sell the money. I mean, sell the note to in Wall Street. So the lender is a bridge loan with a 3-1-1 term. So we have the first 3 years and then we have 2 extensions. It's a non-recourse loan. The rate on the deal is about 5% with a 250 basis point rate cap that we purchased at the time of acquisition of this asset. The lender has put about $1 million in interest reserve and about 1.5 in capex from the lender. And our goal, and this is extremely important, our goal is to refinance as early as this September when we get out of the lockout period. As soon as September rolls in, we're going to reach out to other lenders, see if we can get, a Freddie or a Fannie, or a hard loan and refinance into it. So we have no intention and we do not plan on keeping this loan for a long time. It was a bridge loan, and with the interest rate and everything, if you can refinance it to Freddie, which means more money will be coming your way pretty quick, pretty soon.
All right, next question. If we have to use 401k funds, what is the process?
401k, so that's retirement. It depends. It all depends on the custodian. If just 401k, most of the time you are not able to. I'm assuming you might be coming through your employer. So you have to roll over that money to a custodian that allows for self-directed IRA, and then you can invest. So the answer is yes. It just depends on who's your custodian. Is it an employer chartered custodian, or is it like one of those independent custodian? And we'll be glad to give you options and walk you through all the options. Please feel free, schedule a call with me or Tom, or just call us directly. We have our contact information there, and we'll be glad to explain all the options for you and assist you with the 401 with the IRA investments.
Yes, just to add on top of that, if it's an old 401k, then self-directed is probably the likeliest route you'll need to go. But if 401k from your current employer, then there's a couple more hoops you got to go through. And so we'll be glad to address it with you when you reach out. The next question is just wondering why you need more investors a few more months into it. I believe Jack already addressed this question. The next one, is this a new property or are you recapitalizing from last year?
It's not a recap. It's not a recap for sure. We acquired the property in September. The the amount we need for the entire project is about 25 million, as we indicate on the slide. We just never reach that 25 million we need for the entire project execution. So we're simply trying to get to that $25 million we had targeted we need to raise for the entire project. A lot of that money is going to go into operational funds and other things.
All right. The next one, does this capital raise dilute the previous LPs, or how will it be structured?
No, it does not, because the original plan was 25 to begin with, right? So we've not reached that original calculation we had, back then, right? So right now we're 23 something, and the target is 25. So once we gone about 25, then instead they're diluting. But as of now, no, we're still giving the same projection, which is 2x return in 5 years.
The next question is, what is the distribution frequency?
Quarter. Every quarter.
All right. Do you have any more additional questions or any areas that you want us to expand on a little bit more? Please type it. And just to, bring back one of the items that Jack mentioned is, or at least one of the things that we have shared is that this is a property that we already own and that we already have had data on or how it's performing. So we have the projection, but then at the same time, we already owned enough that we've already got data to support not just our projection, but where we believe it's going. The next question is, how long is the rate cap good for?
18 months.
All right. Mr. Pugh, I came in late. Could I get a recap probably via email? And yes, we will be able to send you the webinar video. You can take a look at. At the same time, please do not be afraid to reach out to either of us for us to give you to be able to answer any question that you might have. All right, we're going to wait for maybe a few more minutes for any additional questions that you might have. Just clarifying, least amount to invest is, least amount is 50,000. Yes.
All right, awesome. This is good.
Thank you, guys. If there's no more questions, I want to take this opportunity to thank you for taking the time to be with us this evening. We do hope we had shared quite valuable information with you, and looking forward to all of you guys joining us on this amazing opportunity. Thank you, and have a wonderful evening.
Thank you. Thanks, everybody. We appreciate it. Looking forward to you guys joining us. We really appreciate it.